Okay, welcome everybody to Wall Street Order's next Super Stock live stream, January 27th, 2022. We are back with a liquid avatar, LQAVF, over-the-counter, LQID CSE. David Lukacs, the CEO. David, welcome back to the program.
Thanks, Jack. Great to be here. Welcome back to the cold.
That's right. You were back in Toronto. I think the last couple of
am.
times we had you on, you were in LA at the show. Then you were at one of your other locations in the US. And now we're back in Canada at the official corporate headquarters. So
Comic Book Central, yes.
yeah, so we're going to get into all the exciting developments in the metaverse space that Liquid Avatar is doing. And of course, look, I'm very excited about this story here because we're seeing that the metaverse, NFTs, the metaverse, the market is very volatile right now. Look, a lot of NASDAQ stocks are down 50%. This has been a very rough week in the markets. But there's no question that this stuff is really, it's here to stay, and it's only getting bigger. And David, since the last time you were on, I think just a few weeks ago, you've had some major news announcements, developments based on your the company's growth initiatives in the metaverse space, with the digital land, NFTs, all that other good stuff.
Yeah.
I think it's also important to emphasize is that, because again, the stock is only, what is it? It's a 16, 18 cent stock. And, a lot of investors, when they see these stocks in Canada that are 18, 20 cents, they think, oh, there's no revenue, there's a development stage or whatever. Actually, Liquid Avatar is starting to generate some, I would use the word either significant or massive, but it's somewhere between significant or massive revenues in the metaverse business, in metaverse NFT sales. I think you put out a number of something like you're getting close to $1 million just for the last few months you did before between October and December. Is that right?
That is correct.
So that's a massive, again, it's a massive number. And that's essentially from, I don't want to say it's from what is the word, a dead start, but it's like, it really happened very suddenly.
It was from a dead start. I want to be candid. I think in the first 3 quarters, we did about $16,000 in revenue. And then we did, very much near $1 million in the fourth quarter. So, we can call call it as it is. It was pretty much a dead stop.
So that makes it even more exciting. It's interesting. A lot of these, these kind of these disruptive technologies is what we're calling them, right? So these disruptive technologies, a lot of times they start off with, for months it could be minimal revenues. It could be, I don't know, 10 grand or whatever the number is, minimal revenues. All of a sudden, a number shows up and people say, wow, something is happening. But when when I see a number like, even 6 figures or 7 figures, $1 million in revenues in basically a quarter in something which is a brand new thing like the metaverse, NFT sales, digital land, to me, that is, that to me is basically time to pay attention. I mean, that's a signal to pay attention because, this means that if you did $1 million from a dead start, you could be doing, I don't know, 5 million a quarter in a few months, and 25 million a year, and that could be worth I don't know, 500 million of valuation in the in the metaverse space, because how many other pure plays are there, right? So it's pretty compelling.
Well, Jack, I think I always say this, that everyone needs to do their own due diligence, and I've run a number of companies in the past that all started out at these kind of levels and found their own rhythm and lightning strike and done well. And I think for the average person looking at our company, what they've got to look at is holistically what we do and where all the pieces fit together. I know that we want to focus on the metaverse, which is the right place to go, but we are starting to hear more and more about how the metaverse is really Web 3.0. And I like to say what social media was to Web 2.0, the metaverse, avatars, and digital identity will be to 3.0. So it is the sharing environment, and it's a reset environment. It's the ability for everybody to coexist, where everybody knows their neighbor and everyone knows your name, right? So to classically look at Cheers. So so digital identity, which is at the core of our business, is a very, very big factor in what we're doing in the metaverse. But we've also hit a chord because one, it's not just a metaverse. It's got a fantasy and storyline to it, and there'll be more of that developing in the coming weeks. And on top of it, we have opened it up to the general public. So while most metaverses, you have to buy anything or participate in that metaverse using cryptocurrencies, we're able to do that with PayPal. So we're one of the first companies to be able to do that. So not
Yeah,
only
that actually makes it interesting. I know you mentioned before, it didn't quite sink into me, but that's actually a big difference because not everybody. I mean, even you talk about the metaverse. I mean, like the mainstream is not completely into the crypto yet. I mean, we're only maybe 20% market penetration, so it really helps that you're able to.
Well, I want to say we work with Wax and they're phenomenal, and our partners at Waxify and MassCult. The ability to open a Wax digital wallet takes about 1 minute. You don't have to remember 17 words, and you don't have to put it in a safe, and it's really an easy, and that's why Wax has grown so well. But it also working with our partners at MassCult and Waxify using the Shopify platform. This is something that everyone is already used to. What we're not doing is we're bringing the metaverse to the masses. I think that's the easiest way to look at it, and we're doing it in a fun and engaging way, which I know we're going to show the people today. But we've got hover bikes and horses, and we had dragon eggs and dinosaur eggs, and you can live on an estate island, or you can live in a community island, or you can live in a themed island where a dinosaur might be running through your front yard and eat your sheep. I mean, there's so many different things that you can do that we are in planning stage. And now, as we reported this week, we've launched our play to earn game called the Lost Kingdom of Tesara. And it's a really cool idea.
So what we're gonna do today, I mean, is we're gonna kind of go through all the recent news, like the Lost Kingdom of Tesara. You have a bunch of other metaverse announcements.
Yeah.
We'll go through them. Hopefully, we can answer some questions. That's really, I want to focus on audience questions because that's really what this is about. So
by all means.
So how do you want to show? Do you want to maybe do like a show and tell? In terms of,
maybe I can start by just explaining it, because it's and then I'll give the URLs and I'll show people and they can go on. So the whole idea is that metaverses are going to take a while to build. This is not instant chicken noodle soup. So we've got to do things in pieces. So one of the things we've done is we started with our land sales, and we'll talk about that. Then what we did is we started talking about where we're going to go and what our game plan is. And our first activity is going to be a mobile game called the Lost Kingdom of Tesara. So the backstory is very simple. The rain has stopped, the waters have receded, and islands have appeared.
Oh, David, I think this is the thing you announced just recently. This is a play to earn game.
It is a play to earn game. It's a play to earn game because we want to kickstart the economy. So to do that, we've offered a play to earn game where people can visit the Kingdom of Tesara in the mobile game. They can put villagers or minions to work, and on an automatic setting, so you don't have to play 50 minutes a day. You can play for 5 minutes a day, and they can gather resources, and then they can craft those resources, bundle them, and turn them into NFTs. Those NFTs can be used in our metaverse to build things. So we're kickstarting the economy now. Reason it's a play to earn. You can earn credits in our game, and you can earn resources. And you can effectively, it's not cryptographic proof of work, but we're deploying proof of work and staking technologies to ensure that we're moving people into the cryptographic realm. And Jack, as you know, today we announced that we're actually, for Aftermath Islands, going to be doing a utility token.
Okay.
So things are coming together.
Yeah. So let's start off with this Lost Kingdom of Tesara. So give us a storyline. Like, again, I'm seeing like all these metaverse plays. They all kind of start off with these play to earn games, right? Like to develop. Okay. So so what is this game about? Do you want to show it on screen? Do you want to do?
Well, I'll try and let me see if I can share my screen. So bear with me. Just takes a moment.
But the idea is that what people go on, they essentially get kind of hooked into it because they're earning. In theory, they're earning money. I mean, it's basically money, right?
Well, yeah. The idea is that the Lost Kingdom of Tesara is a fantasy game where you can do different things. This is again, in the upcoming weeks we'll show screenshots, but you can sign up for an early bonus and it's Aftermath Island /Lost-Kingdom-of-Tesara, but you can get to it from the website, the aftermathisland.com website, and you can earn bonuses. You're going to get credits and bonuses, and the whole idea is that it's got proof of work and proof of staking, and really the lore is very simple. those that are on Aftermath Islands have now found this kingdom, and it's full of wonders and riches, and they can go to it and put workers to work, literally, to explore and gather and mine and do things. And as you go through it, you can hire an explorer, you can visit the kingdoms, and you can put different people to work. And so it's fun and engaging. And then obviously it's play to earn. And you can do crafting. So you can do smelting, you'll be able to work in sawmills, warehouses, processing. All of this is very standard gameplay, but it's something to get people used to doing things and activities that will enable them to earn tokens and earn resources and earn NFTs at no cost. This is a no cost platform. It's all free. And really it's meant to support our account holders and give them things to do to start building our economy inside our metaverse. So I'll stop there for a moment and see if there's any questions that anyone might have.
Okay. Not yet.
That's okay.
Okay. So we'll, maybe people are shy. They'll come in later.
Right.
But okay, so this is exciting. So when did you launch? When did you like officially launch the game? Like how many users? What kind of traction?
No, the game won't launch for another probably till sometime in Q2. But we're getting people signing up today early for it. You've got to build a following for everything that you're doing in the metaverse today.
Okay. Got it. Okay. So how are you going to get people into it? Like, what's the plan?
Well, candidly, we have over 3,000 players, 3,000 account holders now on Aftermath Islands without really any marketing spend. And we're going to be doing a lot of really cool programs, which are coming up in the next few weeks that we'll announce. We're looking at working with colleges and universities and a whole bunch of associations and game clubs. And so we're out there doing that now to get everybody involved, because again, we want people active and excited. And one of the things that you can earn in the Lost Kingdoms of Tesara play to earn game is you can earn Aftermath. We call them today credits. That's the code name. The actual name of the token will not be credits, but we call it credits today. And those credits are, in fact, utility tokens, but they're meant to be an in-game currency. So similar, if you've played World of Warcraft, you can earn gold, you can earn silver, you can earn, coppers. There's all kinds of things that you'll be able to earn and use, and craft and build. So if you want to be, and when I play some games, I like to craft. So there's going to be a large crafting component to everything we do, so people can start to build and earn their own revenues from doing things in the game. And then separate and apart from that part of the thematic game, our community islands are built to work, play, and learn. So you can go about your everyday lives on your community islands. And then for events and bigger players who want to hold private gatherings, we have our estate islands. So the first phase of this is sort of built around our thematic program, but we're not discounting that people will want to do things like, work and play and do their regular lives. And we have all our community islands to be able to do that.
Okay. No. So and the great thing about these types of games is that, well, look, I think we've gotten a bit of a preview with kind of the early success you've had just with the digital land sales with Aftermath Islands.
Yep.
$1 million, and that's a lot of money for I never heard of it before. It's crazy. So if you were able to get traction in that, I think it gives us a preview for what kind of user engagement, how many signups you can get into the Lost Kingdom of Tesara game, and this could become huge. I mean, how are these things valued though? Is it valued based on the user count? Like how does the market value?
I think it's a bit esoteric right now. I think it's. I mean, we own our own platform, so we're one of the pure plays. Although we own our own technology and avatars, and we own our technology and digital identity too. So I'll answer that question.
Okay, sorry, we got questions coming in. So
what was that question, sir? Are the
credits only spendable credits? Basically, the credits that people get from the game, playing the game. Mm-hmm. Is it only spendable?
Well, the answer is simple. Right now, we're making them spendable in the game. If others wish to use them and take them as currency in their own platforms, that's up to them. But we would support that wholly. I mean, some islands trade coconuts. We're going to be, we're going to be doing credit. So at the end of the day, all I can tell you is we'll be open to allow our token to be used elsewhere.
Okay, but so basically, this token, I mean, is going to trade. I mean, this is going to be trade as a crypto, basically, right?
That will be up to our partners and ourselves. Right now, we're focused on the in-game side, but it will be a utility. It will be a cryptographic token. So the answer is it is likely part of the plan, yes. But that's not at the Liquid Avatar side. That is down in our equity holdings in Aftermath Islands.
Okay, very exciting. So let's talk about, I think, there's some interesting things happening with the metaverse. So I think, I don't know, where are we right now in this space? Is it kind of like, is this like the low hanging fruit? Like I keep hearing about major brands, going into the metaverse. I think, I don't know if it was Adidas or somebody, they're opening
Walmart.
stores.
Everyone's talking about their strategy in the metaverse. And Jack, I think it's an interoperable strategy. What I mean by that is you do not see Walmart in one location in North America. They have thousands of locations. The best solution I can think of is Amazon, and I'll tell you why. So you order from Amazon on one site, but they deliver from multiple places around North America and around the world, of course. So there's warehouses in every major city, but you can order from one site. So imagine that an organization puts together a metaverse strategy, a brand. They put together a virtual location, and then each metaverse has multiple doors to get to that location. So there's multiple storefronts, but it's going to be a virtual walkthrough instead of, and we'll be able to show this in the coming months, instead of going to a website and looking at a flat listing, your avatar will be able to walk into a store, take the item off the shelf, turn it over, play with it, read the box, click on the box, click on this, do that, do this, maybe show how I can wear that item. It's going to be pretty cool.
Okay,
That's all I can tell you.
I can kind of see. So basically, so maybe for anybody that maybe you could, my imagination is kind of starting to run where you can go with this, but how does Liquid Avatar monetize on brands kind of migrating to the space? Brands like, I don't know, Walmart, Adidas, whatever. Yeah, I mentioned Adidas.
I can give you an easy example. So I'm going to use an example. So an avatar, it sounds like a bad joke every time I say it. An avatar walks into a bar, right? Or walks in and they order an energy drink, and the avatar drinks that energy drink. And because they're going to go on a quest. And when they drink that energy drink, or they put on that pair of sneakers or trainers, they get a boost. So what that means is they get a power up, just like you played in, Super Mario. They get something for doing that, and that helps them on their quest. And oh, by the way, because their permission-based marketing is turned on, and we know their identity.
This goes back to your
avatar
specialty.
Boom! They get a real-world coupon to walk in and buy that energy drink, a discounted energy drink at the store, or an incentive to buy those sneakers or trainers in the real world. So because Liquid Avatar is at the core, and consumers can opt in, all permission-based, can opt in for certain marketing, they can do things in the metaverse and they get real-world value. This is something that is unique to us because of our digital identity platform, which is free to consumers. And other metaverses are already talking to us, and we're looking at other opportunities because everybody wants multiple points of contact with the user while preserving their privacy, but also ensuring that they're a real person to play in that metaverse. So the answer is we've solved all those issues.
No, so it's so fascinating. So basically, the way this thing kind of is evolving is, let's say somebody goes into they sign up to play this game, Lost Kingdom of Tesara, right? So they're doing it's an engaging game. Some of these games have millions of users, tens of millions of users, right? Especially if it's free, right? And then while they're there, they can get, I guess somehow brands can I don't know if maybe they'll give them stuff or whatever, but they can get like special sneakers,
enhancements, bonuses,
and then it ties into
But that ties into our metaverse program too. It's not just in Lost Kingdom of Tesara. That'll be in the metaverse because all our themed islands will have quests. Or you know what? someone says, you know, on the community island said, you know what, use this branded pseudo computer and we'll give you $100 off your Apple computer or your Lenovo computer. But their branding is on the computer that they're carrying in the metaverse.
Yeah. Or it could be, you know, whatever, like, you know, I think one of your games has like hoverboards or something, or, you know,
hover bikes. Really,
hover bikes. I mean, maybe
I'm gonna show them. I'm gonna show them. So I'm gonna take a second.
Like Honda or Tesla might say, hey, we want to put our brand on it. People also become like a Tesla, you know, hover bike.
Yeah.
And or you know, then they get some sort of coupon in the real world for, I don't know, for maybe a discount or something, basically something to engage them. But these things are all they can all be monetized. You want to show something on the screen?
I'm just trying to find it. Give me one sec. I'm trying to see where it went.
Some questions coming in.
I unfortunately, I think I've closed. Oh, there it is. Let me see if I can share it. Bear with me for one sec. I've got a number of screens open, so just bear with it.
It's I understand why they call it the Web 3.0, because just like everybody needed to have a website, a website back in Web 1.0, they basically need to be in the metaverse to get business or whatever in these things.
So here's a promotion we're running right now. If you spend $300 or more, you get a single hover bike. If you spend $500 or more, you get 2 hover bikes, and they come in black, blue, reds, silver, and gold. And these are and people will randomly get these as NFTs. So again, it's a collector NFT, and it can be turned in for a hover bike when we go live. And each of the hover bikes will have different. They might be faster, they might be slower, they might have certain sounds, and that'll be based on whether they're common, limited, rare, or epic, or legendary. But again, these become rare NFTs. But here's the real super cool ones. For those, and we have quite a few people who have spent more than $5,000 already for land. If you spend $5,000 or more during the promotion period, you get the iridescent emerald hover bike, which has a whole bunch of new customization. But here's my favorite. And again, I have to tell you, I've had to acquire my land. I didn't get it, given to me. And I've got over 500 plots of land already. And so this is what I'm looking forward to as I reach that pinnacle. This hot rod bike, which has got super exhaust, different lights. I mean, it's really all about what is super cool, right? That's really what at the end of the day, what we're looking at is create cool incentives. But remember, these are NFTs that can be turned in for game items, but they are rare NFTs, right? So people can do what they want with them. We don't offer advice, but they are rare NFTs. So you can trade you trade with your friends, do what you want to do, but that's outside our realm of influence.
Okay. No, it's very interesting. So all this stuff at the end of the day, though, you monetize it in multiple ways. One of them, though, is with ultimately connecting brands to users through the games, and we talk about in-game or whatever it is, but
e-commerce, in-game marketing, permission-based marketing, direct sales to the consumer of our land and products and services, and digital identity. How many do you need to become a successful platform? The answer and for Stephen is that jury is out. We've built platforms before that have had millions of people on it, so I don't know that we can say what the number is to become successful. I will say that I've heard a lot of different numbers, and I don't know that I'm correct. So I want everyone to take this with a grain of salt. But I've heard on some days there might be only 500 to 1,000 people on Decentraland at any given time. Now there may be way more, and I might be really incorrect. So I don't have a stat in which to quote that. It's something I heard ad hoc. But if the numbers are that low, and they'll grow immensely. So please don't take that. When there's a festival, there's thousands of people. But look at the value of Decentraland. And so there aren't millions of people there yet. We're building a platform for millions of people to be able to congregate.
Okay. No, it's super compelling. I mean, I think in terms of from the investor side, I mean, the market kind of values these things. Yeah, it's forward looking. So the market's going to be valuing, Liquid Avatar, your kind of your metaverse world kind of based on the traction you're getting, I'm actually shocked that we haven't seen a massive move in the stock because, I don't know how many other pure plays there are in the metaverse space who can say, hey, we generated, $1 million in the last, 3-4 months, selling digital land. I mean,
well, I think we've also said a lot of things during a sort of a very quiet period in the market or a very tumultuous period in the market. So
yeah.
I think we're building a story for long term. Again, I believe it's last week we announced that our platform for the OCSA, the Ontario Convenience Store Association, and 8,000 stores has gone through proof of concept, and we're now going to pilot. So at the end of the day, Jack, our job is to deliver.
Okay, and so you have actually a couple of different lines of business, but it all revolves around digital identity. Is that?
Well, so the way I like to say this, and I have to think of it visually, is at the core of our business, just like the core of a baseball, at the core of our business is digital identity. Okay, nothing happens without that core. Around that is our avatar strategy, and around that is our metaverse strategy, and all work hand in hand. We can work on them independently or cooperatively and collaborative.
Okay, so Steven's asking, will you be making any third-party partnerships to validate your platform?
I believe we will. I can't talk about them, but there's a lot of things going on, and yeah, that makes perfect sense.
Okay, he's also asking, will you be looking for financing this year, or will your land sales sustain you?
We're a micro cap company. We're always looking at financing opportunities, and we're still building. The land sales currently aren't enough to sustain us long term. We hope that they will be. So will other things that we do in our business. But you've got to look at us that we're a micro cap company that is growing and growing exponentially. What we are looking at more so is how to minimize or eliminate, at least in short term, any dilution. We think we're at the number of shares we want to be for today, and we need to see growth before we want to start. That's what we want to do. What we need to do and what we have to do may not always coalesce, but we're very, very particular about what we're looking at in terms of financing because our growth rate is taking off.
Yeah, and I think we should add is that the last time you did a financing, I think that was in the summer, and it was a much lower price, and that
it was a much lower price.
It had like no negative effect on the stock. The stock today is
well,
double.
It did for a week or two, which was fine.
But double. You're double where you were in the summer.
Yeah, we are, and we have been. We're about a 50% higher right now. But the answer is, I think what we need to do is we need to be smart about what we do, because we're major shareholders. We don't want to be diluted if we don't have to either. So okay. Sorry, I saw that come up.
Question for Decentraland had a very successful crypto coin, gained tons of popular mana. I believe that the hype is where they got most of their value. Question come.
Well, I believe Mana and Sandbox. I know people from both of those organizations. They all started out around a penny or so a token. They didn't, and as the metaverse started, gaining traction, they went up. So, we're hoping that if we launch utility token, it will have value to our users. But our focus is really on growing value for the platform and hoping that all the assets and that we own and all the items around the platform will increase in value.
Okay. Let's see what else we have going on here. Okay, so you have the utility token that's launched. You got the game that's
it is launching. Everything is in early stage, and again, you don't. A lot of companies, once they actually finish, and we have delivered on the things that we've promised. So we do have a track record of saying we're going to do X and delivering Y. So the items that we're announcing today, we are very focused on getting them built as fast as possible.
Actually, you've more than delivered. You've had upside surprises. You never said that you would have, $1 million in revenues from digital land sales or whatever it is. And sure enough, there it is. So
we'd rather, under promise and over deliver. That I think that's the makings of what we think is a long-term good opportunity for all of us.
Okay. So I guess Mike is saying basically, listen, David, I should say is, a lot of investors, they like
that. If that's not Mike's real name, he's been watching Porky's way too often.
So no, but there's a lot of investors who really like the fact that there's a lot of transparency here. You're keeping kind of the keeping them updated on all things that are going on, which is very important because when you're in the business that you're in, like kind of when you're in the forest, it's kind of very hard. Like it's very the stuff that you're doing is very common for you, so you almost don't even appreciate that you might be doing a million in digital land or whatever it is, and all these things happening. So. It's really good that you're kind of sharing these details with investors.
Well, we also have other outlets that we use. I mean, I'm very fortunate that I'm now a regular contributor to Forbes.com. So there's articles coming out almost monthly there. And recently, I was asked to, with 3 other people to co-chair the VR AR Association's Metaverse Committee. So I'm doing that, and then I'm going to be speaking at a number of events. So we're trying to be as transparent as we can, and I appreciate the comment, Jack. We certainly aren't going to have 4 news releases a week on average. That just is not going to happen. But we want to make sure that the markets are informed of where we're going, and that you can not only see the pattern, but you can see the story revealing, right? It's all about, if you can see all the dots being connected, you can sometimes see the end point, and that's what we're trying to do. And we believe that will attract hopefully more eyes on our product, services, and investment opportunities.
Okay, so David, let's kind of wrap up here. What other kind of news flow? I mean, you've been putting out updates regularly, which is people appreciate. What else can they look forward to in the coming weeks and months?
Well, we're really focused on again 3 things. We've talked about the MetaHero project, and we've been a bit quiet on that. You're going to see our avatar project start to pick up. Our digital identity programs are tuning up very, very quickly, and we're working towards delivery of pilots now, and we're looking at industries like the travel industry, the health industry, the e-commerce industry, and then on the metaverse side, what you're going to start to see previews of what is going on in our metaverse. What we're thinking. I mean, you don't have to look farther than behind my shoulders to know that we have a lot of interest in the comic book industry, and we think that industry and the people there are some of the best storytellers. And Marvel's made multi-billion-dollar business out of it. The storytelling is really important, but again, we want to focus not only on the themed aspects, but the community aspects and the estate aspects, so that we have a really unique environment. And then lastly, this is really, really important. We are focused on interoperability, the ability to take our products and services on all levels, our digital identity, our avatars, and our metaverse, and making them work with others.
Okay, David, last question thing here, and then we've got to wrap up. Okay, so question, why do you think we haven't seen any other crypto metaverse companies go public? I mean, we've seen Coinbase, there's actually a few, but there's not any really.
Not really metaverse, because one, most of these metaverse organizations are run by individuals that their heads are focused around cryptocurrency, and they're builders, they're gamers. And so I think most of them would rather stay private because they haven't had the experience to want to do what I'm doing right now, right? We've got a public company, and then we have operating companies, and you've got to.
And I think, and this is the great opportunity I think for investors, is because there are very, very few pure plays in the metaverse space. I mean,
I believe. I mean, you can invest in Meta if you want. You go out and buy Facebook stock. You can look at ourselves and maybe a couple others.
This is from like what I like about this from the investment concept is, I don't it's like I don't know of any other pure plays that are actually generating substantial revenues like you are in the metaverse space that are at this market cap and at a 20-cent stock price. And we've seen. Look, I have seen what happens when a theme becomes hot. Whether it was originally the .com era, when there were very few companies. And whatever was out there all of a sudden went up, or even the cannabis era, which people remember, like because there was only a handful of cannabis stocks, the few that were out there all went crazy or psychic, what have you. But so I think the metaverse is going to heat up this year, and it's going to be it could be a real.
And I think we're going to see a lot of spec plays in the metaverse, but you have to ask yourself, what are they really doing? What are they really doing, and how do the pieces fit together? And does management have the understanding, knowledge, and experience to make this happen? And have they done this before and been successful at it? And I think I would like to think personally we check those boxes. And I've said this in the last few days. We've been fortunate to have lightning strikes in our other companies in the past. And again, past performance is no indication of future performance. But I like to think in the back of my mind, I'm starting to hear thunder. And so the rumblings are happening because we're doing, in my humble opinion, we're doing all the right things to be successful. Now, we're not going to be perfect, and we are going to, fall over our feet every once in a while, but I think we're doing all the right things that we can do to start setting the parameters of success in motion.
Yeah. And again, David, I've said this before, is like, my thesis, the investment thesis when you first, signed on as onto our next super stock program last year, as a client, I said, I really don't understand, like, what the hell this guy's talking about. But I do know that, he's had some massive wins and he's been very early into, huge spaces, whether it was e-commerce or like early on when it was, nobody understood it. So I'm hoping that lightning will strike a third time or whatever it is here. And, this will soon be a $10 stock, maybe, who knows?
Well, you know what? I'm happy to see regular value increases and seeing our investors do well, right? I mean, we're investors as well. And I want to also say one other thing, Jack, which question comes up quite often. And why isn't management buying its own stock? I mean, I hear this all the time. If you're seeing the 4 releases that we put out this week, you can imagine how much more is behind the curtains right now. And I'm not saying, I'm not giving any insight or any forward looking on that. We have to be careful that we are not involved when the market could potentially be infected. Not from a materiality standpoint, but we're just very, very, very careful. We don't want to give people the wrong indication and we are committed and we are steadfast in our commitment to our company and its success. So we are heads down building right now.
Okay. On that note, David, I want to thank you, and we look forward to hearing more about what you're doing in the metaverse in the coming weeks.
Thanks. Be well, everyone.
Thank you. Okay. Let's get ready for Relic. Wait. Okay. Let me just fix this. Okay, stand by. We're going to start in just a second. Okay, Lisa.
Yes,
hello. Good afternoon.
Hello. Afternoon.
Okay, thank you for standing by, for your patience. Okay, we're going to start in just a second. Let me get everything up here.
Just raise my chair a tiny bit.
Yeah. Make sure we're at the same.
Yeah, I'm working on it.
Okay. The lighting is okay. So everything is good to hear today. Okay.
Okay.
Perfect. Okay. Okay. Welcome everybody to Wall Street Reporter's next Super Stock live streaming, January 27th, 2022. We are back with one of our favorite super stocks, Reliq Health Tech, RQHTF over the counter, RHT in Canada on the TSX. And Dr. Lisa Crossley, the CEO, is back. Lisa, welcome back.
Thank you. It's my birthday, so I'm delighted to be spending it with you and our shareholders. So
happy birthday.
Thank you. Yeah.
So, by next year, we should give you a birthday. So next year, the stock should be like $10.
Yeah. You can throw me a party then with actual cake.
But the good news is you had this week in the last, things are really starting to cook here. I'm actually shocked that this news with, what is it? This company here.
Datasoft Logic.
It's funny that we have another company that sounds very similar. So Datasoft Logic. This is actually a game changer. Really, and we're going to be talking about kind of the significance of the news. I mean, really, this is something that should be worth $5 a share. I mean, this has the potential to add $5 in value per share, because this business can do, what is it? I don't know, 35 million in revenues. This new contract.
So without hopefully this sounding too much like a high school math problem, but the Datasoft Logic works with over 600 home health agencies and hospice groups. Each of those has 2 to 5 doctors. Each of those doctors will have roughly 600 patients each who would qualify for our platform. So ultimately, the patient numbers here are over 500,000. So we've talked about adding 50,000 patients a year with this client for the foreseeable future. It's possible that will accelerate, but keep in mind this is 50,000 new incremental additions every year. So it's an additional 36 million in revenue every year over the revenue in the previous year. Ultimately,
it's cumulative,
yeah.
You're saying.
So ultimately, this account is worth $360 million at full deployment annually for us. So it's a huge account. I mean, I think it's a tough market right now. So I'm not, completely surprised that the stock hasn't responded. But honestly, the Cognizant relationship is a huge game changer for us. And, I think that maybe hasn't completely resonated with some of the retail shareholders, just because Cognizant isn't a household name, but it's definitely gotten us a lot of interest from healthcare analysts and the investment banks in the US who know the space and who know Cognizant very well. So that's, I think going to be a huge long-term driver of value. It may not happen in the next month or two, but I think our shareholders will, as we get more and more contracts through that, we'll have a chance to understand the significance. And then Datasoft Logic is one of the big contracts we've been working on for quite a while. It's a huge organization, very well respected, with a very large clinician base. So they have thousands of clinicians that they work with, and hundreds of thousands of patients, and they're growing all the time too. So I think that it's a very good validation of the company. It's a real endorsement that a large client like that in California, has chosen to work with a relatively small Canadian company. And I think, it's something that, you can really kind of predictably point to going forward, a significant contributor to revenue from that one client alone, because they are so large. So I think this is kind of the beginning of what we'd talked about, I think, late in the year last year, where we're really graduating to larger size clients, working more with large networks, moving into managed care organizations, hospital systems, that kind of thing, or healthcare systems rather. So the clients are going to be larger and have more of an impact on the bottom line going forward.
Okay, so no, this is not. I mean, last year really was kind of that inflection point. I mean, last March, where all of a sudden you started to scale. Okay, but this is okay. So this is a really big deal. I didn't realize how big this is. Okay, so I thought it was 35 million revenues, a year. But okay, you're saying that this is really, it's 500,000 patients that they have in their network.
Yeah.
And you're expecting to get 50,000 of them each year to bring
onboarded a year. That's the current implementation plan. So that's for this sort of foreseeable future. But again, I think as we move forward, into future years, we'll be able to accelerate, it's not us, as I've said many times,
right,
who are kind of the gatekeeper on the pace of onboarding. But I think clients, when they're starting out, they try to be conservative and assume that it'll be, very complex rollout. Once they've started, they can see that it's actually very simple, no real training required, and very easy to operate. And so we expect that generally, whenever we have an implementation plan, once it actually gets going, that the client will end up moving faster. So, I think there's a lot of potential from this account, and in the next few years you'll see some very significant revenues from this one account.
Okay, but this is okay. But just starting off, I didn't realize that the numbers on the back. Okay, but starting off, it's going to be worth 35 million in revenues next year.
Yeah,
2023. I mean, you're starting, I think, the onboarding in the Q2 Q2 of this year.
That's right. Yeah.
Okay, onboarding, and it's all gonna it's gonna kind of roll out, but ultimately you expect to be adding 50,000 a year. So that's so the revenues basically. So this gives, I mean, for any analyst that want to model this, essentially this gives them a potential roadmap, a path to revenues going. I don't know if the word is it's growing at, I don't know, triple digit. You could have a triple digit growth rate for the first couple of years. Because this is not the only account. This is not the only client you have. You have other clients. Okay, so there's a math. Okay, so but even with that said, 35. I'm just being conservative. Let's say 35 million. With the comps in the space, 20 times revenues in the health tech space. $700 million, or it could be even higher. We've seen 50 times. So that could be worth $3.50 to $5 per share. The stock is only $1 right now.
Yeah.
And this is not the only news you've had. You've had some other major contracts. I mean, everything is just kind of starting to snowball. So it's
Yeah, I mean, we sort of internally talk about being at our second inflection point. I think there certainly was an inflection point in the spring of last year, but there's no question that we're now at a point where we have a valid business and we've got the attention of the market from the client perspective, not speaking about the capital markets, and we've got a lot of credibility. And then adding the endorsement from Cognizant has really raised our profile with some of the larger clients, and they are a definite blue chip stock, blue chip company in healthcare. So, between that and this larger deal that, we've now been able to announce, I think you can see where we're expecting to go over the course of this year. So I think this is a big inflection point. I think we're very undervalued right now. Mind you, the market is such that I think almost everyone is radically undervalued right now.
we've seen Teladoc, a lot of NASDAQ stocks are down, 50, 75%. So,
yes.
Lisa, one of the things I said was, last week when we scheduled the interview, I said, look, I don't really care what news you have, whatever, but, it's good just for investors to know, to show your face that, because it's important in a volatile market that, they see the CEOs showing up, keeping them updated, the transparency. Because there's a lot of we've had, especially in the microcap space, a lot of companies where they're there in the good times, in the sunny days, when everything is great, the sector is up, they show up for they're doing everything, but then like as soon as things drop a little bit, they're MIA, so. It's very, very. I think a lot of people appreciate that you're here today.
Well, this is my last week was my 6th anniversary at the company. I joined in January 18th, 2016. So January 18th, 2022 is my 6th anniversary here. I've been through some bad times with the company and stuck around. Because I've known all along that there's a really valid business here that's going to be incredibly high growth once the factors align. And I think we have that confluence of factors right now where, the Medicare and Medicaid reimbursement levels are really compelling. They were increased again this year, plus new billing codes for remote therapeutic monitoring were introduced. We're getting tremendous market pull. Certainly lots of our clients have been challenged by the pandemic over the last 2 years, these waves, but, hopefully we are getting to the end of that as Omicron is hopefully starting to come down. We're still kind of in lockdown up here in Ontario, but they're predicting that it's starting to wane. But even in the face of all of those challenges, the business has grown very significantly, and I think we're now at a point where the really game-changing growth is going to happen. I think the last 2 contracts we announced, and with Cognizant and with Datasoft Logic, are a pretty good harbinger of what's to come, and they certainly have made us all feel like all of the hard work and all of the blood, sweat, and tears has been very worthwhile.
Okay, so just to emphasize, right now you're doing, I think you said you'd be doing $2 million a month run rate by December. So you're at that number now. You're doing $2 million plus in revenues as we speak.
That's right. Yeah.
Okay, so the company, just as here we stand right now, 24 million in revenues. So if this is worth 20x in the market, I mean, so the stock is still very undervalued just based on the existing business, based on the comps, and of course there's the upside. Lisa, one thing is just in case anybody doesn't know, can you explain Cognizant? What the partnership is about. Why is it so important? Because you've mentioned a bunch. We have a lot of people that may not understand why this is so significant.
Yeah. So I mean, sort of the basics are that Cognizant has a care management component of their healthcare business. Their healthcare business is about $4 billion a year in revenue, but growth has been relatively flat in all of Cognizant's business. I mean, part of that is just they're so massive. They're doing $15 billion a year in revenue. You can't always be in an exponential growth phase, but they're very well respected in healthcare. They have a lot of relationships with over 300 different healthcare systems. They are integrated with over 650 different electronic medical records. And so they're stepping in and being able to offer care management to our largest clients as we go forward. And now, for example, Datasoft Logic, they don't need Cognizant to do care management because a lot of their clients are these home health agencies, so they will want to do the care management themselves. But for other large clients, managed care organizations, health insurance plans, health systems, they will feel much more comfortable that as a small company, we'll be able to scale to deliver on their care management needs if we have a partner like Cognizant, who's very well known and very well respected in the space. And so it alleviates a concern that a lot of the large clients would otherwise have about working with a small company. It's also partnering with Cognizant is a huge sort of good housekeeping seal of approval in healthcare. They are very well known, very well respected. They have a very broad footprint globally. They touch over 200 million patients. So when we, go into a client who's large and maybe hasn't heard of us, they've certainly heard of Cognizant, and they can speak to people at Cognizant, find out about the due diligence they've done on us and why they chose to partner with us. When the last company they partnered with in the virtual care space was Microsoft and Philips when they had their joint venture 10 years ago. So we're in very, good company there. And then kind of the last component of the partnership is, we are going to be working with Cognizant on going into their existing accounts. And there's been a lot of demand for virtual care, remote monitoring, and behavioral health integration, transitional care management, principal care management solutions. So, we're obviously optimistic about being able to help Cognizant with some demands from their current clients. We're also going to be able to respond to RFPs and things from new clients with Cognizant. And I think we're a very powerful team. We bring something very innovative and a very, rapidly growing business. I think with Cognizant, given that they do $4 billion a year, looking at providing care management to us, which they do, it's the same cost to us as if we were paying our internal team, paying Cognizant. So it doesn't impact negatively on our margins at all. Definitely impacts positively on our ability to scale and to attract the large clients. But if you think about, their healthcare business doing $4 billion a year in revenue and feeling that it's worth partnering with us, and as you may have seen in stock news, there are analysts commenting that this is likely to drive revenue growth and profitability, improve profit margins for Cognizant. I mean, think about how much business in the care management Cognizant would be doing for it to be significant for them on a $4 billion revenue top line as it stands. So, I mean, I think they see the value of this market, and they definitely see that we bring something very unique to the space, and that's why they chose to partner with us. So I think, we have a lot of opportunities to grow with Cognizant. We're also able to grow on our own, and landing something like Datasoft Logic, even though they're not going to use Cognizant, that endorsement that Cognizant selected us as a partner is a key factor for these big companies that really we're an unknown and therefore a potential risk. It's de-risked us a lot from that perspective.
So I mean, basically, yeah. So like the key thing is, these your clients in the healthcare space are very conservative, right? So for them to sign up with you, they want to know that this is actually the onboarding is going to take place, that the service, everything is going to happen, and the Cognizant essentially it takes I guess in theory that should take the onboarding questions off the table. Like I know everybody's like always asking about the onboarding, how are you doing with onboarding? But essentially with Cognizant, you're not going to have that issue anymore, right? Like because they can scale.
Yep, and they can help not just with care management, but if we needed help with the actual onboarding, getting informed consent from patients, anything like that, their care management team, those are the sort of human resource intensive parts of the onboarding process. So, we'll never have to worry about a bottleneck there. We'll never have to worry, what if we have challenges hiring enough people or training them fast enough? They've already got people and they already are trained. So, it's definitely, it helps us on the onboarding front. And it's not to say that we couldn't have done it on our own, but it makes a huge difference to be able to say we've partnered with this incredibly well-respected company who really has a ton of capabilities in healthcare. They work with 85% of all Blue Cross Blue Shield plans. They do billing for Medicare and Medicaid. They act as a clearinghouse for claims. They integrate with all of these different electronic medical records. I mean, they really have a comprehensive IT services offering in healthcare. But it's not, it's not a company that all of us have necessarily heard of, but it's a $48 billion market cap company. So it is a very significant entity.
Yeah. Okay. So let's get into some audience questions here. We got a bunch of
Yeah.
questions. Hopefully we have time. Okay. So Josh is saying, so basically this deal with Datasoft Logic essentially doubles your current revenue. It'll double the
It
revenue.
more than doubles the current base. Yeah.
More than doubles.
Yeah, I mean, we've talked about having implementation plans with 200,000 patients that would be onboarded by the middle of next year. But, obviously this implementation plan, if we're looking at 50,000 a year, goes out a little further than middle of 2023, but it covers 500,000 patients. So we're certainly looking at, very conservatively more than doubling our patient base.
Okay. A couple of people actually were asking, okay, so congrats on adding all these contracts. Where are you now in terms of onboarding and collecting revenues in terms of accounts receivable? We got a couple of questions about accounts receivable. How are you doing them?
Yeah, so we have been collecting. Even in December, we'd already started collecting some of those aging receivables. So expect to get those cleared by the end of this quarter, which will be nice. I think our auditors will be very happy about that. Our newer clients, receivables are on standard terms, so we don't have to really worry about aging receivables with the current clients. We're just clearing out that backlog. In terms of onboarding, I think we've talked about this. We hit that $2 million a month revenue run rate by the end of last year, so onboarding's going as we'd expected. I will say Omicron is probably slowing some clients down a little bit, but if that impacts growth at all this quarter, and we don't know that it will, but if it were to, it would be a very temporary thing that would be made up very quickly in the next quarter. So, I think we're happy with how we've been able to respond to, challenging market conditions in the customer market, not just the capital markets, but, that have come from these different waves. We've still been able to kind of keep moving forward and keep growing the business, continue to add clients and patients. So everything's going very well on that front.
Okay, Samantha's asking, okay, congratulations on the new contract. Okay, can you speak to the cost structure regarding your scaling of onboarding patients? Can you speak to the other potential larger contracts in the pipeline, which were discussed?
So I mean, we've certainly talked about there are larger contracts or clients that we're working on, and we'll just have to keep everyone posted on those as they kind of
more good news to come.
More good news to come. In terms of sort of cost structure around onboarding, so I mean, onboarding itself is a tiny component of our overall cost, so it's not really significant. As we scale up, where we really are seeing economies of scale, it's not so much that the cost of onboarding changes; it's pretty consistent no matter how many patients we're adding. But where we see economies of scale are things like server costs. If you have a server and you're not using all of it, but you're paying for it, then your cost per user is higher. Certainly, it's an economies of scale business, as any software as a service is. So the more clients we onboard, the better our margins are. And I think you could see that last year, starting out under 50%, ending up at 72%. So, our margins definitely improve the more patients we add.
Okay, questions about Datasoft Logic. Okay, so Dennis is asking, if Datasoft is able to manage their own care management, does that mean they will be onboarding their patients themselves?
Yeah, so I mean, some of the onboarding has to be done by us, because some of the onboarding isn't so much putting a device in a patient's home and getting the patient up and running. It's getting the patient list from the healthcare provider, putting that into our platform, running the pre-screen through Medicare and Medicaid to ensure that those patients are eligible for the services that the clinician plans to deliver through our platform. So those are pieces that we always will be responsible for. But because Datasoft Logic works with home care agencies and hospice groups. There are billing codes that home care agencies can leverage for installing devices, for training patients on the devices, and the care management piece. So, they'll probably do some of that where it might otherwise be done just by mailing a patient a device and maybe having either an automated phone call or a phone call from our care management team to that patient. So, we've talked about how our sort of premium service with full care management is $100 per patient per month. We've disclosed that with these, clients, our revenue is going to be $60 per patient per month. And that sort of reflects the fact that they'll do a lot of the care management and maybe even a little bit of the onboarding piece.
Okay. Stephen is asking, will you be able to onboard the first 50,000 from this data CureLogic by the end of this year, considering you're starting in Q2?
Probably not, no. And I think it's a little bit like, what is that expression that your battle plan never survives the first engagement with the enemy or something. But so we sort of always think of it as we've got a tentative plan with this client until we start. And then, when we start, they may end up deciding they want to go faster. They may end up deciding they want to go slower. We may hit certain hurdles. There may be another, theta wave or something instead of Omicron that has a minor impact. But, I think we'll know more by the end of Q2 about how many patients will get on from Datasoft Logic this year. And we're certainly, ready and willing to put on as many as they'd like to move forward with. But, we have to work on the client's pace, and we certainly don't want to, scare them by trying to push too quickly, but we'll certainly onboard, I think, a significant number of Datasoft patients this year, but we won't really know, I think, until the end of Q2 what that number is likely to be.
Kind of an interesting question here from Josh. Do you expect Cognizant to buy you out? I mean, you mentioned those could,
Yeah. So, we really are building the business with the intent that we be self-sustaining. We're still planning to uplist to the NASDAQ later this year. And I really believe that you need to build your business with the intent of it being a completely independent organization for its lifetime. I'm not naive about the fact that there is a huge trend in healthcare and probably in lots of other industries towards consolidation. And my goal has always been not to sell the company, but to, at the very least, get us as quickly as possible to a point where if someone were to come in and, try to take over and buy the business, that we could, essentially attract the attention of multiple suitors and capture the highest possible value for our shareholders. So I don't think anything's likely to happen, honestly, on that front anytime soon from anyone, Cognizant aside. I think, for the most part in healthcare, a lot of the big companies really can't value a company for the purposes of M&A until that company has over $1 billion valuation of its own. So I think we've got some time to do some growing and to get to a point where we could get a really compelling valuation if we were to be acquired, but we are in no way courting acquirers, and that's not something I would particularly like to have happen. But it's not a bad thing to have people who are interested, even if we don't sort of go down that path. But certainly we've consciously, from that perspective, really tried to fly under the radar for quite a while, because I think the last thing we wanted was to have someone come in, do a hostile takeover, get bought out when we were really undervalued. And I think by the time at this point that anyone could put in a meaningful offer and do due diligence, go through the whole process, we would have a very compelling valuation before anything happened. So it's not my goal. We've actively tried to avoid that kind of thing to this point. It's not something you can necessarily avoid as your profile rises, but it's not our goal, and we will make sure that we get value for our shareholders, whether we stay our own independent entity or something else happens.
So nothing under $20 a share. No offers below $20 a share will be entertained.
Yeah, great.
Works for me. Okay, question here. That's interesting. There's a couple of interesting questions, and we'll wrap up. Okay, so Richard is asking, now that you're working with these billion-dollar market cap companies, should we expect some mega patient contracts, like mega beyond what you had? I think it's going to snowball to crazy numbers.
I do think that there's definitely a snowball effect in healthcare. There's a lot of, we're waiting for someone else to try you out, and they take the risk, and the more people who do that, the larger clients you get, and it definitely does snowball. I will say, and I've always said that, the larger clients take longer to get across the finish line. So I think, some of what we're doing now, working with these larger clients, you will see, I expect, sort of similar scale contracts announced this year. But I think, 2023 is probably when you're going to start to see another increase in scale in terms of clients. It's going to take a little while for some of these relationships that we're building now, thanks to the Cognizant agreement, to kind of come to fruition. But I think every quarter we'll have a little bit more visibility, and certainly it's not that we're not going to have other large clients or contracts this year, but I think every year going forward from here is going to be full of very pleasant surprises.
Okay. Okay. So we got a few more questions, then we'll wrap up here. Let me just see if we can catch up to these. Okay. So and again, I think we should maybe just put this to bed once and for all in terms of the onboarding.
Sure.
Now that you have Cognizant, helping out in terms of the onboarding, does this essentially eliminate any challenges that you would have?
It does, exactly. So, most of the onboarding process from our perspective is fully automated. So getting those patient lists, doing the pre-screens, having the patients pre-authorizations and getting into the system. And so the piece that's a little more challenging to scale care management is challenging because it's human resource intensive. So we need to hire new medical assistants to do that. Now, as I think I told you on one of our previous visits, we hired 5 care managers and had over 200 qualified applicants for those positions. So, we can scale our internal care management capabilities very quickly. But I think the benefit of working with Cognizant is that, they can scale instantaneously to any scale. So we can reassure a client who says, well, I have 1 million patients and I want to put 50,000 on next month. That's not a problem for Cognizant. So, the piece of the business that was the only potential challenge in terms of scaling very, very quickly was that human resources intensive piece, the care management piece, and that's no longer an issue.
So I think we've used this metaphor before, but essentially this is kind of like the Cognizant deal. Essentially, it's sort of like cloud computing, whereas before, you had a business which is, everything runs off one server that's in somebody's office. Nobody's sure if it can scale to, millions of people going to the website at once. But, when you go on a Amazon cloud or whatever it is, whatever these cloud computers, they can scale infinitely to, billions of people.
We use Amazon Web Services and Microsoft Azure, and part of why we use those instead of maintaining our own servers is it does give customers a lot of comfort that we've got hosting providers who can scale to any scale and have a lot of redundancy. And Cognizant is sort of along the same vein. It just it's a big recognizable brand name in healthcare, and so if we say, oh, the care management piece is going to be taken care of by Cognizant, it just gives people a lot of comfort.
Okay, 2 more questions. That's it. We'll wrap. Okay, so you mentioned. Okay, so I think people. I think NASDAQ. What's the plan for NASDAQ?
We're working on it. We just brought on a new CFO last quarter, so we're working on that process. I think the market being where it is right now, I'm glad we didn't think we were going to try to uplist this quarter because we would like the market to, shake out all of these nerves that it's currently having before we do anything like that. But our plan is that later this year we'll uplist to the NASDAQ. I think, again, we'll know more by the end of this quarter and into next quarter as we have a better sense of other new contracts that we're going to be able to announce and how quickly we're going to onboard with Datasoft Logic. And as we have a chance to see what the market is going to do, it's a pretty dismal market right now out there. But
there's no rush. There's no rush to be on NASDAQ. I mean, and there's not going to be any reverse split, right? Like let it just happen organically. Let the
I think we may not have talked about this too much, but I know we've talked about it a little bit in the past. By the end of this year, we'll be throwing off quite a bit of free cash, and I think the most logical, most value generating for shareholders thing for us to do with that cash is a share buyback. So, I think there's certainly no need for a reverse split. And we really don't want to uplist to the NASDAQ when it's too soon. So if you get onto the NASDAQ by virtue of doing a reverse split, those stocks tend to not do well. So you really want to be at a point where the business is successful enough and has a lot of news that is coming in the near future and will continue to come over the long term. That's a good time to uplist to the NASDAQ. But doing it just to get that initial bump in valuation that you do when you uplist, you'll come down hard and fast from that. So we want to make sure we uplist at the time when it's really the right move for the business.
Yeah. Okay, so question here. How is Datasoft different from other third-party sellers? I.e., aren't they just offering your services to their own clients? How do you know how many of their clients will onboard?
Yeah, so we're not actually using them as a sort of channel partner or resale agent. They came to us because their clients have asked for remote patient monitoring. So the home health agencies have said, the doctors we're working with have said that if we can't find them a solution, they're going to find a different home health agency who can. And so they looked to Datasoft Logic to see if they could build it into their platform, the whole virtual care piece. But they do a lot. They have a very comprehensive platform, but it's not this. It's more around practice management. So, and they've been actively looking for a partner who can handle the virtual care piece. And we, come highly recommended, and we, work very well with home health agencies. We understand that workflow. So, it's not that they're going to sort of be offering us to their clients alongside with their software. It's that this was a requirement from their customers. And so they're fulfilling it by partnering with us. So that's how we got patients. Yeah.
Great question here. In your opinion, what's the biggest catalyst in the next 6 months?
I mean, I think, the big catalysts for us from sort of the capital markets perspective are, getting a few quarters out, getting that data out so that people understand, how quickly the business is growing, and that, there are real revenues here, and showing that we're collecting and getting rid of those aging receivables. I think from a customer perspective, the big catalysts for us are every time we sign a new large scale contract, whether that's a partnership with Cognizant or something like the Datasoft Logic contract, those are definite catalysts. This is very much, we're at that sort of autocatalytic stage where every time you add one of those clients, it attracts the attention of another group of clients at that scale. So we've certainly seen that at the smaller scale, but where you get into the really crazy levels of growth is when you're attracting clients at the scale we're at now.
Are you going to? Okay, so we're going to keep going after small doctors.
Yeah, the smaller clients mostly come to us through inbound sales, so mostly through referrals from some of our existing clients, and it's very easy. As I say, most of our onboarding process is fully automated, so it's very easy for us to add clients to the platform, whether they're big or small. So there's no reason not to continue to service the smaller clients. And there is a trend at consolidation in healthcare, and not just in terms of the businesses, but in terms of clinical practice. A lot of healthcare systems are buying up community practices. So sometimes you might, have a few small practices and then find out that they've been bought by a big network, and it gives you access to a much larger patient base. So there's a lot of value in continuing to support those smaller clients.
Okay, excellent. Last question. Any analyst coverage coming up?
Yes, I'm never sure how much I'm allowed to say about that, but let me just say lots of conversations and lots of enthusiasm, particularly from U.S. analysts. I think, the conversation I have the most often with U.S. analysts is, I don't understand why, you're not getting more recognition in the capital markets. Your share price should be much higher. Because I think, when we talk to the US analysts, they understand Medicare and Medicaid very, very well. They know the space really well, and, they can see that there's really no competition. We are doing something very unique. And I did get a lot of calls, inbound to me from analysts after we signed the Cognizant agreement. I think the analysts in particular who, are really dug in deep in the space very much understand the significance of that. So, I expect analyst coverage is coming. I will say I haven't been courting it. A lot of CEOs will spend a lot of time trying to get analyst coverage. We're not raising money. We don't need to raise capital to fund our own operations. We can do that ourselves. So, while I always prefer it if the share price is doing very well, my focus has really been a little bit more internal on operations and making sure that we're, well positioned for the growth that we're expecting. So I haven't been doing a ton of kind of promotion or outreach to analysts or anything like that. But I think the fact that they're coming to us is a very, very good sign. So.
Okay, excellent. Lisa, on that note, I want to thank you for coming on today for the quick update during a very volatile market. I think everybody appreciates that. And we hope to hear more from you in the coming weeks with massive new contracts and exploding revenues.
Yeah, well, I'll try not to disappoint you, Jack.
Thank you again.
All right, thanks. Take care, everyone.
Okay, let's get ready for our next exciting company here. Stand by. Oh, okay. Okay, Matt, can you hear me?
I can hear you. Yeah. Can you hear me?
Yes. Oh, I think we're getting a little bit of an echo coming from on your side there, but okay, we'll try to manage. Okay, so I think we're gonna have a lot of hopefully we'll have some great questions. We've got a lot of people on the stream here.
Great.
Okay, welcome everybody to Wall Street Reporter's next Superstock live stream, January 27th. We are back with Organic Garage, OGGFF over the counter, OG on the TSX Venture Exchange for those in Canada. I think probably one of the most exciting, risk reward setup type opportunities out there. Company with a 20 million market cap that, it has a path to, 200, 500 million market cap, increase in valuation very soon. So for anybody that's brand new to our program, our goal is to bring you those stocks which have that 10x to 100x upside potential. Companies going after massive multi-billion-dollar market opportunities. They are at a key inflection point, and there are multiple catalysts in place to ignite that increase in shareholder value very, very soon, like in the coming weeks and months. And I think we've definitely been seeing that from Organic Garage. The company's definitely at that inflection point. We know about the market, the size of the market opportunity, but we're starting to see things accelerate. So Matt, good to have you back.
Thanks, Jack. It's great to be here.
Matt, one of the reasons I asked you to come on was like some of our earlier CEOs. I said, hey, the market's really very volatile right now. It's good to just come back and let new people or existing people know that, hey, we're here. The stock is not the business, and the business the two separate things. And at some point, the value comes back, and it's good. It's always good because look, as I've said before, you know when you have a quality company, a quality CEO is when they show up during good times and bad times, not just when the sector is hot or when the market is running, everything like that. So I know that everybody here appreciates it. Matt, I'm starting to hear more happening in the plant-based space. Like it's really going. I think we've seen in the last few years that things are really starting to go mainstream. But I actually just saw a video. This is on YouTube, right? On YouTube with this guy, a VC named Gary Tan, Garry. I think the guy is he's a young guy. I think he's like, I don't know, he's probably 20 years. I don't know. The guy's made billions of dollars. I think he was one of the original investors in Coinbase, a couple of he's had some massive wins, but they're all been tech companies. And he's actually now investing in the plant-based dairy space, dairy. I think put some money into a company that's doing some sort of, I don't know, sounds like some sort of science thing, with I don't know, cells or whatever.
Yeah, there's some like biotech companies that are focused on, flavor enhancing of certain plant-based items to make them mimic more closely their non-plant-based equivalents. So there is a science tech to that.
It's kind of a tech thing, but the thing that and again that appeals to some, may not appeal to everybody. Some people just like something that's a little more organic and natural, not like a science experiment. So, but whatever. But the point of it is this: is that when you see like major investors start to go into the space, especially and one of the things I saw in the video was the guy was very specific. He said, look, the dairy alternative space, plant-based dairy alternative space is, like we talked about before, it's a $900 billion market opportunity.
Oh, yeah.
So this is,
well, I said it before, it's not a fad. It's a fundamental trend that's changing, in the marketplace, what consumers are preferring to eat and what products they're ingesting. So this isn't something that's going away. It's only increasing in popularity. So it is. You're right. It is a very exciting time in the industry.
Yeah, and yeah, no, it's interesting. I kind of didn't even realize this, but so Gary Tan, he's Chinese, and he said that Asians have a hard time eating dairy products. So he was very looking forward to this plant-based alternative because and that's how many? That's 1.5 billion people we're talking about, 1.5 billion people opportunity right there. But not just Asian, but a lot of people are lactose intolerant. They might have 2 billion people potentially.
Or more. I mean, once again, it's only a growing category. It's one of, if not the fastest growing category in the food sector. So it is on fire right now.
Yeah, no, it's very exciting. So, let's talk about this. So right now, Organic Garage, the stock is trading at a valuation of like $20 million. It's $20 million for the whole company. It's basically what the market is valuing this at 32 cents, where it's at today. And it's important to emphasize the company's doing, what is it, $25-30 million in revenues historically. That's just the legacy business with the retail Organic Garage stores. But there's two catalysts right in front of us in the next few weeks, months, which could really ignite this thing and make this a 10-bagger, I believe, in my opinion. One of them is we have an immediate path in front of us to really double revenues with the stores, because I think in an earlier live stream, I think a few weeks ago, you said that you're looking at, because you announced it maybe a month early, but you're going to be opening 4 to 6 new stores this year in 22.
Yeah, we're focused on taking a good sized jump potentially with our Organic Garage retail business, and our real estate team is working very hard. I mentioned last time, we had to reschedule our interview because I was out, doing site tours. So we do definitely see an opportunity to take a serious jump on our retail business, to get to that 8 to 10 store range. And you're right, it's doubling, if not more than doubling our retail business.
So that would basically, and I think again, what's going to happen is because the market is forward looking, as soon as you announce this, and I think you said you're going to announce 4 at once, because it's just from just a operational standpoint, or however, it's just as easy almost to roll out 4 stores at once as it is to do 1 at a time. Or
with the model that we have now, we touched on this when we did that great video walkthrough and things. We feel very confident in our model now. What goes in, we have, like you used to say, we got the binders, we got the checklist, we got everything that makes it easy to roll out stores. It's systemized. So from a construction standpoint, you're right. Whether it's opening 1, 3, 6, the teams are in place to be able to execute that.
Okay, and I think it's important again to emphasize that again when your background originally before Organic Garage was in the franchise industry, and so you understand how important it is to have kind of those systems in place when building out these stores, because that saves you a lot of aggravation and time, because you're not starting from scratch. You already have a template.
Yeah, you don't want to reinvent the wheel. So that's we touched on that. We spend a lot of time analyzing how we want the stores to look, execute, what goes into them. And so from a systemized standpoint, we're there, which is why we're taking a look at taking this, jump to go from, our existing store count to the 8 to 10 store range.
So there's 2 paths, actually 3 paths for this thing to be like a, $2.50 to $5 stock, a 10 to 20 bagger. Path number 1 is let's say you just roll out 4 to 6 new stores, and we'll get into this, the CPG side, which is really the most exciting thing. But if you roll out the 4 to 6 new stores, that's going to bring up revenues to a $60 million plus run rate, right? And I think the market would, once the market sees that you have revenue growth starting to accelerate, they see scale start to happen, all of a sudden you can get a 3, 4, 5 times multiple based on revenues. So you could have potentially a 5 times multiple, forward-looking, 300 million valuation, which would be, I don't know, what's $6 a share, right there. Path number 2 is the CPG side, which I think most investors, apparently that's what they really want to hear about, which is the future of cheese, future of butter. That's your CPG line. Targeting the dairy alternative business, the $900 billion opportunity. Can you, again, we talked about before, I think you rolled out the model. Now, how many SKUs right now? You have 4 SKUs, right?
Yeah, I think it's just important to even just rewind a little bit. I mean, we made the acquisition, you know, last March, you know, to take advantage of the opportunity that was happening in the market. And, you know, it speaks to, number one, we keep a pulse on the food industry with what's going on and what's popular, and then also what's popular in the public markets. And we saw this as a great opportunity to provide enhanced shareholder benefit in a rapidly growing sector that we knew and do know very well. And so we acquired the company. We worked on tweaking a few things and got our products ready to launch. And we launched our first products in late October, early November, and it was great. You know, we launched four new SKUs in basically like 6 or 8 weeks. It was tremendous. You know, in our local market here to gauge consumer response, see what the interest level was, tweak things as needed before a larger scale rollout, and the response was phenomenal. Not only in our home market, but I can tell you across Canada, obviously because we launched here in Canada, but huge response from US clientele who were asking where can they find the product. They heard about it. We got written up in Veg News as one of the hottest new products, the most realistic tasting plant-based brie in the market. We made their holiday list for Christmas time. You know, just tons of social media responses and email inquiries on where to find the product. So we outlined to, you know, in previous videos what we saw for the path for the company this coming year on the future of cheese side, which was 4 main catalysts, which was one, link up with co-packers, specifically in the US, and we'll touch on that in a second of why we're heavily focused on the US market, but link up with co-packers who can produce the items in mass quantities. Our model does not call for a capital intensive rollout approach with us, you know, building a manufacturing facility and having staff. No, we want to leverage the co-packing structure that is out there to grow the business. So that's number one. Number two was to perfect the last 4 to 6 SKUs that we have in the pipeline to get to 10 SKUs. Doesn't mean that we'll end there. It just means that we've been heavily focused on getting to the 8 to 10 SKU mark.
But the key is, I think you've said before, is the key is to get to the 8 to 10 SKUs, because that's the number that a distributor or that's kind of the number that a store they want.
Well, it gives a great variety of SKUs. I mean,
Yeah,
different retailers will have different, obviously, focuses and certain sections that they have available to put products. So if you're only going to them with one and they say no to one, well, what else do you present? So 8 to 10 gives a great compelling offer for the brand. So we felt that was very important. So we're going to work on perfecting those with the co-packer, you know, once we have that signed on. Number 3 catalyst is to link up with, you know, 1, maybe 2 distributors to help deliver the products direct to the retailer, you know, network. And number 4 was to reach, you know, I mentioned 500 doors, but we're feeling very confident that we should be even able to have a runway to growth to 1,000 doors.
In the first year?
In the first year, going back to the point, which is, and I think it's important that people understand, is we are very heavily invested and interested in growing the brand in the US market. It's dominating a lot of our internal discussions and our future of cheese team. And I think from an investor standpoint, they should be very excited about that, because given the size and scale of the US market. But I can't tell you the level of interest from consumers in the US market has overwhelmed our team and has made us, you know, take a very hard look and say, look, you know, let's give a real hard focus on the US market. And that's why we feel even hitting up to 1,000 doors is definitely achievable. And so when you look at those 4 key catalysts, you know, when it comes to not only growing the brand, and so I'll just give you the quick math here that I've touched on in previous calls, which is 10 SKUs with an average turn rate of 1 case per SKU per door. So, you know, and this is going back to 500 door math, not even 1,000 door math. So we'll focus on 500 door math.
Yeah.
But 500 doors, 1 case per SKU per week per door, with an average unit cost of $5 to the distributor. Some of our SKUs cost less, some of our SKUs cost more. So we're using a good average. And once again, some retailers will sell more than 1 case. Some retailers will sell less than 1 case, which is why I say 1 case per SKU per door as an average with a $5 unit cost, pack 6 is a $7.8 million a year company. That is the math. Multiply that by
this is not okay. So once
multiply that by 2 if you're hitting 1,000 doors. So that's why we feel very confident, you know, in following this path, linking up with the co-packer, perfecting our SKUs, linking up with quality distributors, and then scaling to 1,000 doors. That is the runway. That is the math, and that's why we're heavily focused and taking a very hard look. A lot of our team is focused on conversations in the U.S. market, and why we're super excited for what this year is going to mean, for the future of cheese. And then touching on that, just the opportunity that exists in the plant-based organic food CPG market. Since we've acquired Future of Cheese, companies have reached out to us inquiring, what our plans are for the future. And we do see a path towards, looking at select acquisitions in the future in the CPG space, just given the popularity and, our expertise in that. We know the food business, the plant-based
Right. I mean,
business.
you operate, very successful organic retail stores. So, it's a natural fit that you could, will be a good product, in terms of acquisition. So,
Well, we're on the cutting edge of understanding what the consumer is wanting. We get to see products before they even hit the market. And once again, I've said on this program before, we're at the epicenter of the plant-based movement. Plant-based companies come to companies like Organic Garage to launch products well before they launch in mass retail. And so we're able to see things, before they're even, so-called popular. So, it gives us a tremendous amount of market insight. And gives us a tremendous amount of, kind of a head start on what companies could be up and comers and what might be worthwhile acquisitions to grow, our CPG side of our business. So
okay.
I think there's a lot of exciting stuff going on.
Okay, so when you have so what we could expect, I think what investors could expect this year, right? I don't want to put words in your mouth, but let's say the next 12 months, right?
Yeah.
Is that the Future of Cheese, the CPG line, the dairy alternative, plant-based dairy alternatives, that's going to roll out. I mean, the goal is to get it at least into 1,000 stores in the U.S., mostly U.S., Canada. So you call doors, so 1,000 plus
doors.
stores. And that'll generate roughly 15 million based on the numbers you said.
The run rate to that, yes. Depending on listing deadlines, I mean, look, certain retailers have specific criteria, but our goal is during this next 12 months is to sign up and have the runway to growth through 1,000 doors at retail. And so
that's just for starters. Because
that's just for starters.
We've talked before that Oatly is in 90,000 doors. So when you're saying 1,000, it's not like you're getting the whole market. You're not even scratching the surface. So in theory, you get to 1,000 doors, right? Year number 2, you might be in 3,000 doors and doing 45, 50 million. You have more SKUs, and the people on your team, like you had Yossi, who's with Danone. He's done that. He's built. He's scaled businesses. The consumer. In the yogurt space, all these weird dairy whatever products. He's scaled massive businesses like that. So this is
the team's in place. You have the 2 co-founders, Afram Bersi and Craig Harding, on a curation and marketing and PR side. You got people like Yossi Herber on our advisory board, who brings the corporate CPG background on the marketing side and knowing how to promote and market the brand. And so for us, the building blocks are in place. We want to be able to leverage a co-packer to help scale the brand. We don't want this to be, a capital-intensive business where we're having to invest in facilities and things like that. It was never designed for that. We want our team focused on product development, R&D, and we want them focused on marketing and promotion. For anybody who's looked into Afram and Craig's backgrounds, they've been on the Food Network. Afram just had a very successful TV show air on the Food Network, where he traveled the world visiting cheese producers. Craig has been on the chef programs on the Food Network.
They have a lot of street cred in the gourmet food.
They have a ton. And getting them in front of media to promote the brand, which they've already done to some respect, which is why we've gotten write-ups on things like Veg News and things like that, a U.S. publication. But let them focus and be the face of the brand and promoting it and pushing it to the consumer. And let's leverage the co-packer on what they do best, which is manufacturing. And so we feel this is the path towards success for the brand. We feel the 4 milestones that we've outlined for this calendar year are very reasonable for us to hit, given the the inroads that we've already been working towards on the co-packer front. Our team has been very busy on that front, so we're very excited. So we feel the 4 milestones are achievable, and we're working very hard to hit them.
Okay, so let's say you do 15 million in the first year, right? 1,000 stores. the market values, even like the Nasdaq, a lot of stocks are down 50%, but still, the market was willing to pay a multiple of 10 times revenues for companies in this sector, in the dairy alternative sector, especially when you have this type of growth. So if you can get to 50 million in year one, year two, the market's forward looking. If they see you doing 50 million run rate year one, they're going to assume you could be doing 25 million year two. So that's 250 million valuation right there, just right there, and that's $5 a share. So Matt, actually, potentially this could be a $10 stock, because you really have in here. And by the way, I'm being 100% serious. I know but it's the reality.
I
right?
let you quote the numbers, Jack. You know the numbers. Look,
but it's the reality, right? So because you have these two businesses, they're kind of like, they're by themselves, each one of them in the next year could be worth 250 million plus, so potentially 500 million valuation, 250 for the or more.
I've said it, and as a company we believe it. Both companies have a tremendous amount of runway for growth. We feel it's a unique period in time where we have on both sides of the business the right brand, the right team, the right product mix at the right time. So for us, it's about capitalizing on that opportunity on both sides of our business, the retail side and definitely the CPG side. And look, the CPG side, the multiples, yes, on valuations are much higher than at retail, which is why, once again, we're always looking for opportunities to enhance shareholder value, and why we took this opportunity when it came to us on the CPG side. And so, we're super excited. We feel the U.S. market has a tremendous amount of growth potential to really scale the business up rapidly. And our team is very focused on that. And those 4 key catalysts, you know as well as I do. I mean, the market will interpret it as they want, but it points to a tremendous amount of growth opportunity. And hopefully that leads to share price appreciation. But it's just a unique opportunity in time that we're super excited. We have the right people, the right product, the right brands at the right time to capitalize on it. So we're focused on growth.
I think what could be maybe what the market is really looking for, I think what's going to be the catalyst to unleash this kind of value that's kind of trapped in the stock almost, is when you announce the U.S. market, when you announce entry into the U.S. market. Because I think that some investors might be thinking, because like we're actually getting like a decent following in the U.S. now in terms of the stock, but I think that once they see that you're actually going to this market, they're going to see, okay, now these guys can really start scaling this, because maybe they think, okay, Canada's kind of a small market, but but the numbers you throw out, the 50 million, that's just the Canada market, the 4 store 6, that's only in local. So there's a really massive upside. But I think again, the market is probably looking for an announcement of entry into the U.S., maybe with a co-pack or something, or a distribution deal.
Yeah, I feel very strongly the co-packer will be a large catalyst, because the co-packer will outline to the market where our focus is going to be and what capacity is, because everything kind of snowballs very quickly after that. So that's why I outlined those 4 key catalysts: co-packer, rounding up the SKU development, distributor, and 1,000 doors. And those are 4 very achievable milestones for the next 12 months. And you're right. I appreciate it. Every investor has the right to have a wait and see approach, and that's their choice as an investor. All I can say is we're super excited. I'm super excited. It's why I love getting on calls like this, Jack, with yourself, and answering questions or telling people what we're up to, because I see what's going on behind the scenes, and I kind of know what's coming down the pipe, and I feel super excited about the direction we're taking. I think the focus on the U.S. market, given the inbound interest that we've seen, tells us that there's a huge opportunity there, and I think the stock should respond accordingly once we have some announcements that are in the pipeline coming up. So it's very exciting.
Let's get into some audience questions, but I'd like to just emphasize. It's an incredible opportunity here, where the stock being 20 million valuation, essentially it's like a private market value. I mean, there's private companies that get bought out for more than that when you have the types of numbers you're doing. I mean, you're doing what, 25, 30 million revenues. So yeah, it's crazy. And then you have a path right here. You have where this can be a 500 million market cap, and this is not without any kind of like, and it's not difficult. I mean, it's the bar is very low. You just double, just 4 more stores.
Well, we just remind people we're a real company. We're not a paper company. We're not a startup. We're not having to raise capital to fund operations and things like that.
Matt, the problem is you're too real. You're too real. In Canada,
probably,
the investments on the
people
TSX,
aren't used to real companies.
No, they're used to these. They're used to like development stage, or something is it's coming whenever. But when they see real revenues, like I've actually noticed that when actually they see real revenues, they kind of get like they don't know what to make of it all.
Yeah.
What's going on here? This should not be happening. But you actually have, and I think what's going to happen is I think over the next year, as we build the U.S. market following, and by the way, look, you're here with Wall Street Report. I mean, our whole focus is U.S. market. Sure, we have a following in Canada, but I think as we get in the U.S. and when you get the product in the U.S. investors do pay. They're willing to pay for the opportunity, which is the upside is again 500 million. That's a 25 to 1 upside to where the stock is right now. Is that right? Wait, $10. Basically, the stock could be $10. 50 million shares out, 500 million. The math is very easy. It's not like we have to do any kind of complicated stuff. Okay, let's get into audience questions. When can we expect new SKUs for Future of Cheese?
Yeah, the team's been working hard, so we have a good repertoire kind of in the pipeline. I think just going back to the milestones that I outlined, our key focus right now, I said that I think in our December call, was to sign up at least one co-packer, during the first quarter of this year, and we're working hard towards that goal because I think our next round of SKUs are going to be perfected along with the co-packer. Sometimes there's tweaks that have to be made to make it scalable and be able to be mass produced. And I think for us, our initial focus is we're maintaining our 4 existing SKUs and sales continue to grow with those in our local market. But our initial hard focus is signing up a co-packer. The 4 to 6 SKUs, I would say, if I were to estimate, they're probably 75% done. So they're market ready, but we're not going to rush them to market because we feel that last perfection of them is really going to be done hand in hand with the co-packer to make sure that when we do put them out to market, that they're able to be scalable with a co-packer. So I think that is an important step.
Okay, interesting question from Erez. Hi, Matt. Deep and long investor here. Okay, this guy's got a lot of stock. I have a question for you. Why is getting a co-packer sign up proving to be a difficult task if you're working on it full time?
Yeah, good question. It's not a matter of it's difficult or not difficult. It's finding the right co-packer. Certain co-packers have certain limitations. It's not a matter of just going to a co-packer and it's they can produce anything that you present to them. And especially part of what makes Future of Cheese so great is it's unique. It's not like another SKU in the market. And so sometimes that takes us meeting with a co-packer and discussing with them and having to alter production techniques and things like that that they're not used to. The other thing I think is important to note is we launched our products, I would say even the first week of November, and then we basically had 5 weeks to launch our SKUs before we hit the December slowdown. With everything going on in the economy and production and supply chains, it's not a great time to be approaching co-packers. So I said on the program in late December that we were going to hit the ground running in January, and that's exactly what we've done. And so the team has been very busy, already in discussions with co-packers about capabilities, production techniques, what our SKUs are, what SKUs are we have in development. So this isn't something you rush, because once you find the right co-packer, scaling that is immaterial. You can grow very rapidly. We want to sign up with the right partners who can really grow with us and keep up with the growth that we expect for the brand. Okay,
Matt, this guy's got a lot of shares. He's got like 3-4 kids. They got to go to school. Like he needs the stock to go to $10. I mean, they got to eat. So Okay, so Samantha is asking, congrats, Matt. Can you please speak to the balance sheet and current monthly burn versus the next 1 to 2 quarters? Interesting question.
Yeah, great. I mean, look, our balance sheet, in my opinion, is very strong. We did some stuff to, project out where we want to be over the next, 18, 24, 36 months and preparing the business for that. We have no large capital outlays. So from a cash balance standpoint, we're very strong. And from a burn rate, the great thing about Future of Cheese is it's a very small capital intensive business, given the fact that we're not investing in hard infrastructure like a manufacturing facility and things like that. That is not the business model that we have. And Organic Garage, for our short-term business objectives, have more than enough cash on hand. We've always said we would only be in a position of raising capital if we felt that there was an opportunity to take a serious jump in the business. And whether that's on the Future of Cheese side or a potential acquisition on the CPG side or a large ramp up in store
And
growth
you have
on the Organic Garage side.
Matt, I think you have what? You have like 3 million in cash on hand?
We have north of 2 million in the bank. We are not burning capital for our operations. So we're in a great position, balance sheet wise and growth wise, to properly evaluate any opportunity that comes our way and not be having a gun against our head to make a decision. So yeah, it's a great position to be in.
Okay, so let's see here. Interesting question. David's asking an interesting question. Matt, given the other nut-based cheese and butter products already on grocery shelves, how will your products differ?
You got to try them to know, because the taste profile is unbelievable. And I speak to,
how many different yogurts are there? I was like this.
Look, there's always room in the market for variation. The question is how do you differentiate? And for us, it was always on the taste profile. And so going back to the co-founders and the management team, the whole genesis of the business was to create items that mimic their dairy-based equivalents, because you had people like Afram Pristine, who is a cheese expert. And so he's curated things like our plant-based brie, like you would a dairy-based brie. Why? Because he actually manufactured them in France. He knows the production techniques. So, I just speak to the taste profile. And look, you can look on the media and things like that.
This is not like some, I think essentially it's almost like artisanal quality cheese. This is not like some, corporate thing from Kraft where they're just saying, hey, it's plant-based, it's some.
No, we're looking.
These guys are the experts. They've done, we had your guy, what is it? One of the guys from, he was, what is it called? Maître de fromage, right? It's like
Maître de fromage, that's Afram. Yeah.
Like big thing in France. You gotta be an apprentice for years to learn the craft of making cheese and butter.
And he's Canada's own, I believe. So, when you talk about expertise, you can't get better than that. So, I just speak to the taste profile. Look, there's room in the market for variation. Jack, you said it. Look, there's tons of nut-based milks. It doesn't mean that, there should only be one. Our job is, with our taste profile, is to differentiate ourselves and show the customer how good plant-based products can be. And how they can mimic their dairy-based equivalents for those people who are skeptical. And I think we've proven that point with the SKUs that we've launched so far. And so that's what helps differentiate ourselves in the market.
Okay. So Case, I think what he's asking is, are you still receiving interest from landlords in the US? Because I think you mentioned that you had a bunch of real estate guys in the US, I think in New York market, that reached out to you about opening stores in the US, Organic Garage stores.
Yeah, we're always having, there's always ongoing conversations, at differing levels of interest and seriousness. I think the great thing that, anybody who's watching this program should realize is that even though with our we're not 1,000 stores here in Canada, so the penetration that we do have in the market, we're picking up interest not only across Canada, but in international markets like the US market. So, we're always willing to have those conversations, whether it be partnerships, licensing deals and things like that. But I think it speaks to the potential of the brand that, it translates well to any market.
Matt, we've talked about this before. It's kind of like a perfect storm right now. You're in the right place at the right time to expand into the US with the stores because, you have a massive demographic, change happening. You have the millennials, you have the Gen Z guy. Was it Gen Z? or whichever one, the one after. But basically, you have this massive
Y, Z, Z,
whatever it is. But there's a
all of
massive
them.
wave that's going to be the biggest. They're going to be the biggest population in the U.S. market. Very short. I mean, they're already. I think they are actually now. But they're all in their 30s, early 30s, many cases, and we're seeing in terms of real estate development, like you see these like kind of like multifamilies, apartment buildings going up, which like these 4 or 5 story buildings with big retail base at the bottom, which can fit like a 5,000, 10,000 square foot store, which is exactly what you're doing. And most importantly, they really want a tenant like you. They want to have an organic garage in there because that's actually a selling point for them, for their tenants, because millennials are, they're lazy. They want convenience. They want instant gratification. They don't want to get into a car and drive. So they want to go downstairs or whatever. They want to walk 2 blocks and get their organic products.
I think, and I've touched on this before, when it comes to where the market is. Grocery food specifically is extremely hot right now. Why? Because we're coming out of a global pandemic where grocery was an essential service and pandemic proof. And so if you're a landlord looking for tenants in your development, you're looking for businesses that can withstand things like that, and knock on wood, we never go through something like this again. However, it's a landlord's job as a long-term, owner of a building to look out into the future, and they want to protect their investment. And so there's no better tenant right now than a grocery anchor. And then you extend that one,
especially
further.
This is like a hit brand. I mean,
well,
you're like
you,
a hit brand.
You extend that to real estate developers who are looking for something different, which we definitely check mark that box in terms, you saw the way our stores look and feel, and we did a great walkthrough. But then extend that to the industry that we're in, which is the organic and natural space, which is the one of the only sectors that is really growing very rapidly in the grocery sector, given people's pivot towards health and wellness. And so you add up all those 3 things from a landlord interest level, which is why I said, we announced what we were planning to do in our domestic market, and we were swamped with sites. And then that extended to people picked up on that press release and saw it in international markets, asking what our interest level was there. Why? Because they have landlords and developers that want something different in their building, something that is on trend, and something that is pandemic proof and an essential service. And so we check mark all those boxes. And so for us, the interest level has never been higher, and it gives us great confidence, for the growth prospects that are, in the future.
Yeah, and again, I think if you can just, and you mentioned there's multiple ways of expanding in the U.S. internationally, whether it's your own stores, you could license, partner. There's multiple ways of doing it, franchise, whatever it is. But I think once there's a first organic garage in the U.S. market, that would be a game changer for the stock.
Yeah, we'll always look. We're always evaluating opportunities and what we feel is best for the brand.
Even Vancouver. Vancouver also. I mean, for
absolutely,
Canada,
West Coast Canada. Yeah, it's definitely a viable market. And for us, it's evaluating those opportunities and figuring out, what makes the most sense short term and long term. And all I can say is there's always conversations going on that side of the business, and definitely on the CPG side of the business. And so, I'm excited because, like I said, I get to see behind the curtain. And all I can say is, it makes me very excited for what we have coming down the pipe.
Okay. Did you announce a co-packer previously? Like I think back in April, maybe?
Yeah, we did. And once again, we have ongoing conversations with them, in terms of, what they're able to produce for us and what that means for our long-term growth. And so they're definitely in the repertoire of co-packers that we continue to discuss, and talk with. But it doesn't limit us into, further discussions. And so, with our focus on the US market, there's certain limitations, in terms of what a manufacturer can produce and export, internationally. And so we just want to make sure that, understanding now the interest in the US market from the overwhelming response we got as our SKUs launched and got picked up by media, we understand that the US market is something we want to heavily focus on. And so there's some limitations with Canadian, domestic co-packers who wouldn't be able to necessarily export internationally. So that limits us a little bit. But definitely in the repertoire, with that, those conversations have not stopped.
Okay. No, really. So there's 2 massive opportunities, 2 massive, catalysts here between the, the expansion of the plant-based line, the CPG line, to, more SKUs, more doors. So that that's a path to $250 million valuation right there, based just on 15 million of revenues run rate this year. I think that could happen. And of course, if you do, you announce 4 to 6 new stores, organic garage, that's another, 250 to 250, maybe even 300 million value. So really, there's multiple paths to get to a $500 million valuation, which is a 25x from here. So that's almost $10.
Yeah, and look, that's why I'm on here today, because want to keep people that are following our story or new to our story informed with what the potential there is, and all I can say is behind the scenes, we're working very hard to reach those milestones that we've discussed, and I'm very confident in our ability to execute on those, and what that will mean for definitely the company itself, but obviously what that will be interpreted in the public markets, and the potential that there is there in unlocking what we feel is the true value in our stock price. So it's very exciting. There's a lot going on behind the scenes that is very exciting, that I expect to have some good news coming up in the near future.
Okay, excellent. Matt, on that note, I want to thank you, and we look forward to hearing more good news in the coming weeks. Thank you, everybody, for joining the program today.